Welcome to the Deep Dive. Today, September 23rd, 2025, we're really going to try and cut through the noise. We've got a lot of recent crypto analysis you've shared, and we want to distill the most crucial bits for you. See, our mission today is navigating what feels like two massive, kind of conflicting forces in the market right now.
That's right. On one hand, you've got these, well, genuinely huge regulatory breakthroughs could really change things long-term for institutional crypto.
But then on the other hand,
we're staring down some pretty serious, immediate macroeconomic risks, things that could just slam the brakes on this recent rally.
Okay, let's unpack this. So we have this potentially market-defining, really bullish news coming out of the SEC. Great stuff. But that optimism, it's being seriously tested. We've got the Fed looming and this specific big altcoin event just around the corner.
Exactly that tension. That's pretty much the whole story right now. So for this deep dive, we really need to synthesize three key things for you listening. First, what does this new U.S. regulation actually mean, for the long haul, for the industry? Second, where's the market's head at right now? What are the key sentiment indicators telling us? And third, we have to prepare you for the volatility. It's pretty much inevitable with these Fed speeches coming up and that massive token unlock event.
Right, let's start with the regulatory news. Because it feels, well, pretty seismic, doesn't it? A real sign of maturity, maybe? The U.S. SEC has finally announced its innovation exemption rules.
Yeah, and this isn't just, fancy bureaucratic talk.
No, the stated purpose here is specifically to reduce the barriers, make it easier to launch new, compliant crypto products.
Which is a tremendous philosophical shift, really, and it seems to be coming from the very top. Remember, historically, the SEC's approach was basically trying to, shoehorn crypto, this entirely new asset class, into old, rigid securities laws from decades ago.
Right, designed for stocks and bonds, not DeFi.
Exactly. So the core shift here is the new chairman, Paul Atkins. He's apparently made establishing a clear legal framework a top priority.
Okay, but hang on. Haven't we heard clear legal framework promised before? Feels like we hear that phrase a lot. What actually makes this different? Tangibly?
Well, think of this innovation exemption as the SEC basically saying, okay, we're building a dedicated fast lane on the regulatory highway specifically for compliant crypto businesses, instead of forcing them onto that old crowded highway built for, 1930s finance.
Ah, okay. So it's about the process.
It's the certainty, exactly.
Yeah.
Firms don't have to just guess anymore if they might accidentally break some obscure rule tomorrow. They have a defined path. It moves the whole conversation from, uh-oh, is this whole thing even legal, to, okay, how do we structure this safely within the rules?
And what's fascinating here, as our sources point out, this isn't just happening in the U.S. bubble, right? There's already a joint U.S.-UK task force formed specifically to harmonize crypto regulations.
Precisely. And that U.S.-UK link-up, that could potentially set a global standard, which is huge. Think about it from the perspective of big institutions, the BlackRocks, the Fidelities. This regulatory fragmentation, different rules everywhere, it's been a massive headache.
Yeah, complicates everything.
Harmonization means less legal risk when you're operating across borders. And that just accelerates this long-term trend we're seeing, the institutionalizing of DeFi. If I'm a risk manager at a big bank, this task force, that's basically the green light I've been waiting for to maybe start developing new products seriously.
Okay, so who benefits immediately from this clarity? Right now, we're looking at short-term boosts for DeFi, obviously.
Yeah.
And RWA, real-world assets.
Yep, RWA. And layer 2 scaling projects, too.
Maybe we should quickly clarify RWA for anyone not tracking every single acronym.
Good idea. RWA just means putting real-world stuff, physical value, onto the blockchain. Think tokenizing real estate or gold or what's really common now, U.S. Treasury bonds.
Right. Things that absolutely need legal certainty to work on-chain.
Exactly. They rely entirely on it. So this regulatory clarity gives them a massive, massive boost.
Okay, but there's always a flip side, right? A necessary caution here. This is great for compliant projects and ones playing by the rules, but...
But the flip side is, projects that really prioritize high anonymity or maybe have a, let's say, unclear legal status. They might find things get tougher as regulations inevitably get more specific, more demanding, while it separates the wheat from the chaff, so to speak.
Makes sense. And looking longer term.
Long term, this clarity allows for much more complex financial products on the blockchain. We're moving beyond just simple spot trading. We're talking genuinely compliant crypto index funds, for example. The source material specifically mentioned Wisdom Tree.
Okay, like ETFs, but for crypto, properly regulated.
Exactly. Firms like that can now operate with much, much greater confidence. It's industry maturity, really, happening right in front of us.
So the regulators seem to be clearing the path. That's the bullish side. But let's pause. Because all the regulatory clarity in the world doesn't mean much if the market is just, bleeding capital. How do we actually read the conviction, the market pulse right now?
That's the key question.
Our sources project, initially anyway, a positive reaction, expecting Bitcoin to maybe hold that crucial 112K support level, even with the recent negative pressure.
Yeah, and the 112K level, it's not just some random number. It's a really important technical and psychological line in the sand for the bulls. Often lines up with things like the 200-day moving average, the last big consolidation high, stuff traders watch closely.
Yeah.
So if this regulatory news helps Bitcoin hold that line, it kind of validates that longer-term bullish view. But to be sure, to confirm that positive sentiment is actually real and has legs, we have to track 3 critical indicators.
All right, what's indicator number 1?
First up, ETF flows.
Right, the exchange-traded funds. How's the money moving there?
Well, the recent story there is actually pretty cautionary. It's significant. Bitcoin and Ether ETFs, they've seen massive outflows recently. $439 million out.
Wow, $439 million out. That shows real caution.
Or fear, frankly. Yeah, probably linked to those earlier regulatory jitters, maybe macro uncertainty creeping in. So the real test for this new SEC news is it strong enough to actually stop that selling trend, to reverse hundreds of millions of dollars flowing out? That's what we need to see.
Okay, that makes sense. Indicator number 2.
That's the Fear and Greed Index, classic sentiment gauge.
And where are we sitting now?
Right now we're parked at 43. That's squarely in fear territory.
And that's down, isn't it?
Yeah, it's actually dropped from 45 yesterday, and it was 52 last week, so the trend has been towards more fear, not less. Shows that bearish feeling is still pretty dominant.
43 is definitely not a confident market feeling.
No way. For us to really confirm genuine, sustained optimism, we need to see that index move decisively. Get into neutral, maybe 50 or above, or ideally flip over into greed. Until that happens, any price pump is likely just, speculative, could be short-lived.
Got it. And the third indicator to watch?
Bitcoin dominance, usually written as BTCD.
Right, the percentage of the total crypto market cap that's in Bitcoin. And that's currently high.
It is quite high, yeah, sitting at 57.7%.
What does that tell us?
Well, a high dominance usually means capital is playing it safe, hiding out in Bitcoin rather than venturing into riskier altcoins. But think about it. A clear, friendly legal environment, like this SEC news suggests, that should naturally boost interest in some of those smaller projects.
Like the RWAs, the compliant DeFi stuff we mentioned.
Exactly. As investors feel safer exploring beyond just Bitcoin and Ether, if that confidence returns, we should see BTCD start to drop. And that would signal the potential start of a broader altcoin season.
So that 57.7% number needs to come down for the altcoin bulls to feel truly happy.
Definitely. Needs to drop for them to breed easily.
Okay, so we have the regulatory tailwind, we have the sentiment indicators to watch, but here's where it gets really interesting. Because the market isn't just looking at U.S. regulations, is it? It's also waiting, maybe anxiously, on these powerful, immediate macro threats. Threats that could just, override all the good news.
That is the critical point here. All this positive regulatory stuff, it's kind of conditional on the macro environment not falling apart. And the biggest event on the immediate calendar, the highest importance one, is definitely the upcoming speeches. Fed Chair Jerome Powell, Vice Chair Michelle Bowman.
We just can't escape the Fed, can we?
Never. We absolutely cannot forget. Fed monetary policy is the single biggest influence on all risk assets, stocks, bonds, commodities. And yes, crypto. It's what drives liquidity, drives capital in and out of the whole system.
So what's the real danger here? What's the risk scenario we absolutely have to watch out for with these speeches?
The risk is a hawkish speech.
Hawkish.
Yeah.
Meaning tough on inflation, keeping rates high.
Exactly. For listeners maybe less focused on macro jargon, hawkish just means the Fed is still laser-focused on fighting inflation. It suggests they might keep interest rates high, maybe even hike them more, which means money stays expensive, hard to borrow, hard to access.
And expensive money doesn't tend to flow into speculative assets like crypto.
Precisely. So if Powell comes out sounding hawkish, gives that kind of message, it could trigger significant downside pressure. That's where we could see Bitcoin potentially testing much lower support levels, maybe down towards 105K.
Oof. So if that 112K line breaks,
Then the 105K is kind of the next major psychological and technical support zone. A break below that could be really damaging, might trigger cascading sell orders. So to really solidify any upward move we get from the SEC news, we absolutely need a moderate tone from the Fed. Not aggressive. Anything too hawkish could just kill the rally.
and the long-term drag is just high rates make risk assets less attractive, right? Slows down capital flowing into crypto no matter how good the regulations get.
That's the underlying reality, yes.
Mhm.
Sustained high rates are a headwind.
Okay, so macro risk number one, the Fed. What's the second immediate risk factor? The one specific to the altcoin space. That brings us to this looming $12 billion HYPE token unlock, doesn't it?
It does. And this is a huge, what analysts call an idiosyncratic risk, specific to this one asset, but with potential ripple effects. Look, massive token unlocks are always tricky for the market.
Why is that? Exactly. What's the mechanism?
It's simple supply and demand, really. You suddenly release a huge new supply of coins onto the market, in this case, $12 billion worth. These are often coins held by early investors or the project team who might now be looking to sell and take profits.
Creates enormous concentrated selling pressure.
Instantly, yeah. Can really destabilize that specific altcoin's price and potentially the broader market segment if it's large enough.
And the immediate impact might be localized, but you mentioned contagion risk.
It's real. The analysis specifically flags decentralized derivatives exchanges, perp DXs, and especially Hyperliquid, which is the project behind the HYPE token. They'll likely see negative pressure.
But it could spread.
Crucially, yes, this kind of pressure, if it's severe, could easily spread across the broader DeFi sector, just through panic, through fear. If traders see one major DeFi token plummeting because of its tokenomics, they start questioning the tokenomics of all similar projects, creates a negative feedback loop.
Okay, that sounds pretty bad. Is there anything mitigating this? Any good news on that front?
Well, there is some context we absolutely have to mention. Hyperliquid itself, the team behind HYPE, they haven't just ignored this. They've actually proposed a pretty proactive plan specifically to try and address these unlock concerns to counteract that selling pressure.
Oh, what's the plan?
Their proposal includes cutting the total HYPE token supply, and not by a small amount, by staggering 45%.
Wow, nearly half the supply. That's
I get it.
fascinating.
It's a big move.
Yeah.
And the relevance for you, the listener, is pretty clear. Long term, you want to see projects that prioritize sound tokenomics. Projects willing to adapt, even make dramatic moves like cutting supply to meet market expectations and maintain stability. That's generally a good sign.
So it's an attempt to defend against the unlock's downside.
Exactly. But the unlock event itself, still a major source of potential high volatility in the near term, definitely something to watch.
Okay, let's try and pull these two big conflicting stories together then. Synthesize it all. We've got this fundamentally bullish legal framework pushing things up.
Yep, long-term positive structure.
Colliding head-on with these bearish macro threats from the Fed, and this specific token dynamic pulling things down.
Downward pressure, short-term risks.
The analysis suggests the most likely outcome, near-term anyway, is probably range-bound volatility, like messy, choppy trading.
Yeah, that seems plausible. Sideways action, maybe with a slight upward bias as the market slowly digests just how foundational that regulatory news really is. But volatility is the key word.
So given volatility is pretty much the only certainty here, how should people listening think about managing risk, preparing for these events around September 24th?
Okay, let's break it down. First, Powell's speech. That is, without a doubt, the most critical event in the immediate term. You absolutely must anticipate volatility around that time.
And what does that mean practically?
Practically, we strongly advise avoiding high leverage positions around the speech itself. Seriously, the biggest mistake people make isn't failing to anticipate the volatility. It's getting their highly leveraged position wiped out by a quick 5-minute spike or dip during the speech or right after.
Right. Keep leverage low or stick to spot.
Stick to spot or extremely low leverage during that critical window. Play it safe.
And beyond just leverage, what else should we be watching?
Keep an eye on traditional markets too. Look at the DXY index, that's the US dollar strength, and US Treasury yields. These often move inversely to crypto, so watching them can give you clues about how the broader market is interpreting the Fed's impact.
Okay. And what about tracking the reaction to the SEC news itself?
Yeah, don't just watch the price go up, assuming it does.
Yeah.
Look at the quality of that price increase. Is the optimism backed by high trading volume?
Why is volume so important there?
Because high volume suggests real, sustainable money is entering. Maybe institutional money finally feeling comfortable. A low volume pump, That's often just retail excitement, maybe some short covering. Much more fragile, easily reversed. Volume confirms conviction.
Makes sense. And finally, the HYPE dynamics.
If you hold tokens anywhere in the DeFi ecosystem, not just HYPE itself, you need to monitor HYPE's price action closely around the unlock. If it drops sharply, quickly, that contagion risk is real. It could absolutely cause a domino effect across other DeFi assets, even if their own fundamentals are fine. Fear spreads fast.
Okay, so vigilance is key there.
Absolutely. And if we connect all this back to the bigger picture, look, given the current level of uncertainty, these powerful conflicting signals we've discussed, effective risk management is just paramount right now. It's essential.
Meaning diversification, stop losses.
Yes. Diversification across different types of assets, maybe different sectors within crypto, and definitely using stop-loss tools to protect your capital if things go south quickly. The market is basically shouting, "Warning, volatility ahead." You really have to listen to that warning.
All right, that brings us towards the end of today's deep dive then. Let's do a quick summary of that core conflict. The foundation, the structure of the crypto market, it feels like it's getting exponentially stronger, thanks to this clearer regulation, potential institutional acceptance.
The bedrock is solidifying, yeah.
But the weather, the immediate environment, driven by the macroeconomy, it remains incredibly stormy, potentially dangerous.
Great analogy, sunny long-term forecast, but hurricane warnings for tomorrow.
So what does this all mean? It feels like the legal landscape is finally clearing up, paving the way for serious institutional money, creating that roadmap for massive capital inflow we've talked about for years. But that money, it's only going to actually flow into the system if the Fed gives it the room to breathe.
That's the bottleneck. Until Jerome Powell gives some kind of signal that the worst of the monetary tightening is over, or at least pausing, we're kind of stuck in this high-tension waiting game.
Between the potential and the immediate reality.
Exactly. And that's the tension you really need to hold in your mind as you navigate the next few days and weeks. Which leads to maybe a final thought for you to consider. Even with the SEC creating this innovation exemption, giving that legal clarity we crave, how much will all that technical innovation, all the new product development, actually matter in the short to medium term? How much does it matter if global central banks, led by the Fed, continue to aggressively drive liquidity and capital out of the entire financial system through restrictive monetary policy?
Yeah, that's the multi-trillion-dollar question, isn't it?
Yeah.
Regulation opens the door, but does liquidity actually walk through it?
Something important for you to think about moving forward.